Imagine you've owned a rental property for years. You've managed the tenants, paperwork, and repairs, and are finally ready to sell the property. Whether you're just tired of being a landlord or want to cash in on this real estate investment, let's say the sale will give you a $100,000 profit. While that sounds terrific, the reality is that between federal and any state taxes, you might owe $30,000, leaving just $70,000. But what if I told you that instead of having to pay the government, you could use a legal loophole to keep all your profit working for you? Well, this rule is called a 1031 exchange, and I'll review the basics in this podcast. You'll learn how to defer a real estate tax bill and use the government's money to build your own wealth. Whether you're considering buying your first rental property or maybe you're a seasoned landlord, you can't afford to ignore this strategy. Welcome back, everybody. This is episode 988 of Money Girl. I really appreciate you downloading the show. I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. If you want help achieving your money goals and building wealth this year, my next workshop is titled Set Your Money Strategy for 2026, How to Prioritize and Achieve Financial Goals. When you subscribe to The Money Stack, you'll automatically get an invitation to this live event. I hope to see you there. You can learn more, ask money questions, and sign up for The Money Stack at lauradadams.com. You can also leave a voice message with your question or comment by calling 302-364-0308, and you can find all this information in the show notes. All right, today we're going to get into the 1031 exchange. What exactly is this? Well, it's pretty simple. It is a tax deferral strategy that allows real estate investors to sell a property and then purchase a similar property without paying any capital gains taxes at the time of the sale. As with many IRS rules, its name does come from its section of the Internal Revenue Code. With a 1031, you basically just roll over profits from one property into another one. That allows you to continue growing your investment without losing a significant portion of your profits to taxes. However, a 1031 exchange does have strict rules you have to follow. Otherwise, your profit will be subject to capital gains taxes, and of course, that could result in a large tax bill. So let's go through the rules so you understand exactly what this exchange is all about. So to qualify for a 1031 exchange and defer capital gains taxes, you must follow the following rules. So one is you have to keep your funds with a qualified third party. So the proceeds that you get from a property sale has to be held by a qualified intermediary called a QI. It could be a closing agent or a real estate attorney who will transfer your funds to the seller of your replacement property. So the qualified intermediary ensures compliance with IRS regulations. So you want to be sure to work with someone who is experienced in 1031 exchanges if this is a strategy you want to employ. Another rule is that you have to purchase a like-kind property. Basically, your replacement property has to be similar to the property you're selling, and it must not be a personal residence. For instance, let's say you rent out the original property. In that case, you've got to rent out the new one. It has to be basically an investment property or for business purposes. However, the properties don't have to look the same. They don't have to be the same type or even be a one-for-one swap. For instance, you could exchange two single-family homes for an apartment building, or you could swap out a duplex for a commercial office, as long as they're investment properties. And you have to purchase a replacement of equal or greater value. So if you buy a less expensive property than your original one, you would have to pay taxes on the difference. For instance, let's say you receive $100,000 in profit, but you only spend $80,000 on a replacement property. In that case, you'd be subject to capital gains taxes on the difference, or $20,000. And you have to purchase a replacement property by a deadline. So you've got 45 days to identify properties in writing, and then 180 days from your closing to close on a new like kind property. Otherwise, you won't qualify for a 1031 exchange and you're going to lose all those nice tax deferral benefits. So, let me take you through 4 steps you have to follow for a successful 1031 exchange. Number one, you got to sell a property. So your original property is known as the relinquished property. And as I mentioned, you can't receive the proceeds directly after closing on the relinquished property. They must be handled by a qualified intermediary. Number two, you have to identify a replacement property. So after the closing date of your relinquished property, you've got a short window of 45 days to identify one or more replacement properties by making written purchase offers. Number three, you've got to purchase the replacement property. You've got 180 days to complete the purchase of a replacement property after the closing date of your relinquished property. And number four, you get to defer capital gains taxes. If you reinvest all the sale proceeds into a replacement property, you defer capital gains taxes, and that means you keep your profit working for you by growing your real estate portfolio. In other words, you've got, more money to invest. So what are the benefits of doing this? Well, certainly avoiding capital gains is the primary benefit or reason to consider a 1031 exchange. Depending on your income, tax filing status, and how long you've owned a property, the capital gains tax rate could be 15 or 20% plus any applicable state taxes. So you're saving all that money. You're deferring this tax with a 1031 exchange. So that keeps your money working for you rather than going directly to the government. You can make an unlimited number of 1031 exchanges in your lifetime, allowing you to defer taxes indefinitely if you continue to reinvest the sale proceeds into similar properties. So over time, that growth can significantly increase a real estate investor's wealth. In addition, a 1031 exchange allows investors to upgrade their properties. For example, you might sell a small rental property and then use the proceeds to buy a larger multifamily building. That could generate higher rental income or even appreciate at a higher rate, building your cash flow and net worth. Another benefit of a 1031 exchange is that it can support estate planning. Your heirs may inherit your rental property at a stepped up basis. So that means that they get the value as of the day you died. And that means there would be no capital gains taxes for them to pay. For example, if you bought a rental property for $200,000 and it appreciates to $500,000 by the time of your death, your heirs would skip the tax on the $300,000 of gains. So that's, just a basic example. But what I'm trying to show you is that rolling over those profits means that your heirs could eventually have all that capital gains tax erased after your death. So what about the downsides of a 1031 exchange? Well, one downside is that you must intend to hold the replacement property for investment or business use, such as owning it for at least 1 to 2 years. So that means you can't exchange a property that you want to quickly fix up and flip for a profit. Also, be aware that owning a property for less than a year means gains are taxed at higher ordinary income rates, not at the more favorable capital gains rates. Another downside is if the replacement property won't be as profitable as you hoped, especially if the housing market changes. You could end up wishing that you had taken the profit from your original property and just settled up with the government. In addition, the time limits of a 1031 exchange could put some unnecessary pressure on you to find a suitable like-kind property. If the housing inventory is low in the areas where you're looking to buy, you may not be able to identify a property within 45 days. If you're interested in a 1031 exchange, a good strategy is to begin looking for replacement properties before selling your original property. That increases the likelihood that you can find a great property and avoid missing 1031 deadlines. Now, one question that comes up is whether a 1031 exchange is eligible for any personal use. Many real estate investors purchase rental properties that they intend to use personally. For instance, you may offer short-term rentals on your beach condo or your mountain house while reserving a few weeks a year for yourself. So is that allowed in a 1031 exchange? Well, the IRS generally says you can't exchange a vacation home. There is a safe harbor rule that offers a loophole. For a 1031 exchange to be valid, you must meet the following rules for each of the 2 years after buying a replacement property. Number one, you have to rent it at a fair market value for at least 14 days a year. And number two, you must limit your own personal use of the property to 14 days or 10% of the rental days, whichever is greater. For example, let's say you rent the property on Airbnb for 200 days a year. In that case, you could only stay there for 20 days during the year, so that's 10% of 200. Or if you rent it out on Airbnb for 100 days, in that case, you could stay there for up to 14 days. That's the maximum. And by the way, exchanging a traditional long-term rental for a short-term rental is considered a like-kind purchase because both are investment property, so doing that is just fine. Personal use is defined as any time spent at a property by you or any other person with an interest in it, like a co-owner. It includes all family members staying for free or at a discounted rate. However, family can stay in your property if they use it as a primary residence and they pay you fair market rent. Again, you have to follow these rules for that limited personal use for the first 2 years, and that's just to prove your original investment intent to the IRS. But after that, after the 2 years have passed, you can use the property any way you like by extending your stays or even moving in full-time. To sum up, a 1031 exchange is a powerful rule that allows real estate investors to avoid taxes, keep their capital working, and support sound estate planning. However, you must follow the IRS rules carefully, so I recommend working with a real estate professional who can guide you through a successful 1031 exchange to avoid costly mistakes. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a Quick and Dirty Tips podcast. We've got a great team that works on the show. I want to thank Steve Rickyberg, our audio engineer. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. Rebecca Sebastian is our marketing and publicity manager. And Nathaniel Hoops is our marketing contractor.